What is the dealing range theory? A dealing range is the price range between a swing high and a swing low after price has taken out both buy-side and sell-side liquidity.
A swing high is a peak formed when the price reaches a high point and is followed by lower highs on both sides, while a swing low is a trough formed when the price drops to a low point and is surrounded by higher lows on both sides. When price action takes out both buy-side liquidity above a swing high and sell-side liquidity below a swing low, the range from that high to that low, or vice versa, becomes our dealing range. Within this range, we break down price action into three key concepts. The first is external range liquidity, which appears at the swing high, known as buy-side liquidity, and the swing low, known as sell-side liquidity. These levels are typically where stop-loss orders and breakout trades are triggered. The second is internal range liquidity, found between the swing high and swing low. This is the area where price consolidates and fluctuates before making its next major move. The third concept is premium and discount zones. The range is divided in half by the equilibrium level. The area above this midpoint is the premium zone, a more favorable place to seek short positions, while the area below is the discount zone, offering better opportunities to seek long positions. The midpoint of a dealing range, also called equilibrium, is essentially the fair value of price within that range. We use dealing range structure to make smarter decisions about where to enter or exit the market. If price is in the discount zone, it means price is relatively cheap compared to the overall range, making it a more favorable area to look for buying opportunities. On the other hand, if price is in the premium zone, it is relatively expensive, making it a more favorable area to look for selling opportunities. By applying this concept, we can set a clear market bias, bullish in discounts, bearish in premiums. Anticipate liquidity runs, where price may reach to grab stop orders. Plan trades more strategically by aligning entries and exits with how smart money operates in the market.
There are two main types of dealing ranges, bearish and bullish. In a bearish dealing range, price first sweeps an old high before moving down to sweep an old low. In a bullish dealing range, price first sweeps an old low before moving up to sweep an old high. However, in both cases of forming a dealing range, the resulting area has the same structure, a premium zone and a discount zone, where the market behaves in the same way in each. But how can we apply dealing range theory to identify favorable entry and exit zones in the market? We said that the dealing range area is divided into two zones, premium and discount, by the equilibrium line. The price in the premium zone is suitable for entering short positions, while in the discount zone, it is suitable for entering long positions. However, the main point we mentioned was that price action within a dealing range is divided into external and internal liquidity. External liquidity refers to swing highs and lows, toward which price constantly moves and attempts to break. These areas are usually where stop losses or buy and sell stops are triggered. On the other hand, internal liquidity refers to imbalances that appear as fair value gaps, where price reacts once it reaches those areas. Therefore, we can say that the path of price movement is from internal liquidity, or fair value gaps, toward external liquidity, which represents support and resistance levels. So let's take a look at this chart. First, the market formed a swing high and a swing low. After that, price moved in a way where it first grabbed the buy-side liquidity, basically taking out the swing high, and then it swept the sell-side liquidity, which was the swing low. That move set up a bearish dealing range. Inside this range, we treat the swing high as the dealing range high and the swing low as the dealing range low. These levels act as external liquidity. Now, if we split the range in half with an equilibrium line, the top half becomes the premium zone and the bottom half becomes the discount zone. When price is trading down in the discount, we see it as undervalued, so it's a good area to look for buys. On the other hand, when price pushes back up into the premium zone, that's where we expect better selling opportunities. From there, we look inside the range and focus on the internal liquidity, things like imbalances, to find clean setups for entries. There are two important points here. First, in a bearish dealing range, we don't take long trades, we only go short. In a bullish dealing range, it's the opposite. We only go long. Second, in a bearish dealing range, we don't enter trades in the discount zone. We wait for the price to reach the fair value gap in the premium zone. So, In this chart, we take the fair value gap that formed in the premium zone as our entry point, and we set our stop loss and take profit levels up to the external liquidity. I hope this video was helpful for you. Be sure to check out more charts and don't forget to like and subscribe.